Imagine waking up one morning to discover that the harder you work, the poorer you seem to become. Bills are paid, taxes are filed, and yet every year the gap between effort and security widens. This video begins with a question that feels uncomfortable because it challenges a deeply held assumption. What if financial struggle for ordinary families is not primarily about spending habits or bad choices but about invisible tax mechanisms quietly draining progress? The mystery is not whether taxes exist, but how they subtly reshape outcomes without most people ever noticing. To understand how this happened, we need to step back and examine the financial systems that govern daily life. Modern taxation did not emerge overnight, nor was it designed solely to punish or restrict. It grew out of wars, industrialization, and political compromises that promised fairness while embedding complexity. Families today inherit these systems without context, interacting with rules built for economies that no longer exist, yet enforced with modern efficiency. The twists come when well-intended policies collide with human behavior and unequal information. In the earliest days of income taxation, the stated goal was redistribution during national emergencies. Governments needed revenue quickly and targeted those who could pay the most. Over time, this temporary solution became permanent, layered with deductions, credits, and exemptions meant to soften the blow. Each layer was a response to pressure from interest groups, voters, and industries seeking relief. Cause led to effect, and complexity became the price of political survival rather than economic clarity. As industrial economies expanded, payroll taxes were introduced as a stable funding source for social insurance programs. These taxes appeared simple, even benevolent, because they were tied to benefits like retirement and healthcare. The hidden effect was that they applied uniformly to wages, not wealth. Families who depended solely on earned income shouldered a heavier proportional burden, while those with capital income often faced different rules. What looked neutral on paper quietly favored certain paths over others. The rise of withholding systems marked a turning point in perception. Taxes were no longer something most families calculated themselves. They were removed before money ever reached a bank account. This reduced resistance and increased compliance, but it also obscured true cost. When pain is spread across paychecks, its cumulative impact becomes harder to grasp. Over decades, this design normalized the idea that shrinking take-home pay was simply part of life, not a policy choice. As housing became central to middle-class stability, tax incentives were introduced to encourage homeownership. Mortgage interest deductions and property tax write-offs promised relief. The unintended effect was inflationary pressure on home prices, rewarding those already positioned to buy while raising barriers for new families. Cause and effect intertwined as policies designed to help families buy homes ultimately made homes less affordable, locking many into perpetual renting without equivalent tax benefits. Education followed a similar pattern. Tax advantage savings plans and credits were created to support learning, but they required surplus income to use effectively. Families struggling month to month could not front the costs needed to claim benefits later. Meanwhile, student loans grew as a substitute, with interest often non-deductible or only partially relieved. The system rewarded planning capacity rather than need, reinforcing inequality through administrative design. Healthcare taxation added another layer of distortion. Employer-provided benefits received favorable tax treatment, encouraging companies to bundle insurance with jobs. Families outside stable employment paid more for the same coverage with fewer deductions. The effect was dependency on employment for basic security, amplifying vulnerability during layoffs or economic downturns. Tax policy did not merely collect revenue. It shaped how risk was distributed across society. Over time, these mechanisms converged at a breaking point during economic crises. Recessions exposed how fragile household finances had become. Families discovered that fixed tax obligations remained even as incomes fell. Temporary relief programs were announced, but their complexity delayed access. The cause and effect chain was clear. Systems optimized for efficiency in good times magnified hardship in bad ones, revealing structural fragility rather than individual failure. The fallout extended beyond immediate losses. Long-term wealth accumulation stalled for entire generations. Missed investment opportunities, depleted savings, and increased debt became compounding disadvantages. Taxes interacted with penalties and interest, turning short-term cash flow problems into enduring burdens. What began as neutral collection transformed into a feedback loop that punished volatility, something families experience far more than large institutions. Public response often focused on personal responsibility narratives. Budgeting advice proliferated, while structural analysis remained rare. This framing diverted attention from systemic design. Cause and effect were misattributed, and reforms targeted behavior rather than rules. Families internalized blame, assuming their struggle reflected personal inadequacy instead of predictable outcomes of complex taxation interacting with unequal income patterns. Policymakers attempted fixes through targeted credits and rebates. These measures provided momentary relief but added further complexity. Eligibility thresholds created cliffs where earning slightly more resulted in losing benefits. Families learned to fear incremental progress because it triggered higher effective tax rates. The system inadvertently discouraged advancement, illustrating how partial solutions can worsen the underlying problem when layered onto an already intricate framework. As technology advanced, compliance became automated. Algorithms flagged discrepancies, and enforcement tightened. Meanwhile, access to sophisticated tax planning tools remained concentrated among the wealthy. The informational asymmetry widened. Families paid what software calculated, rarely understanding alternatives. The cause and effect imbalance between enforcement efficiency and taxpayer comprehension became a defining feature of modern taxation. Globalization added pressure as capital became mobile while labor remained local. Governments competed for investment by adjusting corporate and capital taxes, often shifting the burden toward consumption and wages. Sales taxes, value-added taxes, and fees expanded quietly. Families felt costs rising without clear attribution, reinforcing the sense that money vanished faster than it arrived. Modern data underscores the pattern. Effective tax rates for middle-income households have remained stubbornly high when payroll, sales, and local taxes are combined. At the same time, wealth concentration increased. The repetition is striking. Policies meant to stabilize revenue repeatedly default to mechanisms easiest to collect, not those least harmful. The cycle continues because its effects are diffuse and delayed. Parallels emerge in today's gig economy. Independent workers face self-employment taxes that double certain obligations while lacking employer benefits. Flexibility comes at a fiscal cost rarely discussed upfront. Cause leads to effect as families trade stability for opportunity, only to encounter higher effective taxation that erodes gains. History echoes, but the labels change. Housing affordability crises reveal the same structure. Property taxes fund local services but scale with assessed values rather than income. Families experiencing paper gains face higher bills without increased cash flow. Tax policy converts nominal appreciation into real pressure, sometimes forcing sales. The system treats assets as liquidity, ignoring lived reality. Retirement systems also reflect repeating patterns. Tax-deferred accounts reward consistent contributions over decades. Families disrupted by layoffs or caregiving gaps miss compounding benefits. The cause and effect outcome is predictable. Those with stable careers accumulate advantages that persist long after employment ends, while others fall behind despite equal effort. Attempts at comprehensive reform often fail because they confront entrenched interests and voter confusion. Simplification threatens beneficiaries of complexity. Each failed fix reinforces cynicism and fatigue. Families adapt by lowering expectations rather than demanding clarity. The mystery introduced at the beginning deepens. Struggle persists not because solutions are unknown, but because incentives resist change. Understanding these dynamics reframes personal finance narratives. Taxes are not merely line items. They are behavioral signals shaping decisions about work, housing, education, and risk. Cause and effect storytelling reveals how individual choices interact with structural design. When outcomes repeat across generations, pattern recognition becomes unavoidable. The first takeaway is awareness. Families who understand effective tax rates across income, consumption, and benefits can anticipate traps before they spring. Knowledge does not eliminate burden, but it restores agency in planning and negotiation. The second takeaway is skepticism toward partial fixes. Credits and rebates should be evaluated for cliffs, timing, and accessibility. Temporary relief can mask long-term harm if it increases complexity or dependency. Cause and effect analysis must extend beyond headlines. The third takeaway is collective engagement. Structural systems change only when pressure aligns across groups experiencing similar effects. Recognizing shared patterns transforms isolated frustration into informed advocacy. The warning is clear: ignoring design guarantees repetition. The open question remains whether future reforms will prioritize transparency over convenience. As technology enables ever more precise collection, the temptation to rely on hidden mechanisms grows. Families face a choice between passive acceptance and active understanding. If this story reshaped how you see everyday finances, continue the conversation. Share this video, question assumptions, and explore how policy design affects personal outcomes. Understanding the system is the first step toward changing its impact.